Hi, I'm Jim Jubak, and welcome to my YouTube video for June 30th. I'm doing a Q&A probably next week, or at least next week we'll tell you when it's going to be. So you need to send in your questions. I've got a lot of them so far. Send us those questions on social media, and I'll answer them when we do the video. If you like this video, please give us a thumbs up. But if you're subscribed to my YouTube channel, you get a notification of when each one is. You can also see more of my stuff, including 3 portfolios for long-term 12 to 18 months and dividends. My free site, which is jubakpicks.com, 6 portfolios, which includes some ETFs and some really risky longer-term stuff if you've got a long time horizon, as well as some options plays. And that's my paid channel, which is jubakam.com. Okay, the title is Position Your Portfolio for the Recession, however you think it's going to turn out. Basically, how you're positioned depends on how severe you think this recession is going to be. If you think it's a bad recession coming up, you should be taking risk off the table. You should be probably even taking some of your bread and butter off the table. If you think this is going to be a relatively mild recession, and we dropped about 1.6% at an annualized rate in the first quarter, you should basically, I think, take some risk off the table, but you can kind of wait it out. I'm inclined to think this is going to be a very severe recession, so I'm looking to take lots of risk off the table, put lots of money into cash. This is a chart of the S&P for 2022. We're down about 19.2% for the year. You notice there's been some rallies, but it's been a pretty grim year. Okay, I think at this point what's priced in down here is a recession. Remember, recession is 2 quarters of negative growth. We've already got one. I think we're going to get another one. But I don't think what's not priced in here is a severe recession. What's priced in here is a relatively moderate recession, with the Fed being sufficiently impressed by the downturn to taper off its rate increases and actually maybe even start to cut rates by the end of 2023. That's here. This is consumer discretionary. You'd much rather have been in the S&P as a whole than in discretionary stocks, because these are much more sensitive to the possibility of there being a recession. So this is the Consumer Discretionary Select Sector SPDR Fund. It's down about 31% for 2022 to date. So this is part of the S&P that's done worse. So if you're looking at a recession scenario, one of the things to remember is that there are sectors that are going to do worse than the market as a whole. This is an example of one that was seen in 2022. Okay, last one to look at. This is consumer staples. Now this is the stuff that people need to keep buying, so it's not discretionary. So it's instead of a vacation trip or a hotel stay, it's Kleenex. So this, as you might expect, has not been down as much. We're talking about only a 4.42% drop in the year. Pays a pretty decent dividend of 2.5%. So if you think that this is going to be a mild recession, this is the part of the market you'd like to be in. This will only work as a place to stash your cash if that scenario comes true. If we're looking at a more severe recession, this will go down as well. So some of the questions I've been getting recently is, what do I think of an S&P index fund? Well, from my point of view, thinking that the recession is going to be severe, I think an index fund is going to be a bad place to be positioned. I'd rather be in consumer staples or in utilities. However, if this is going to be a really tough recession, utilities and staples won't be the place to be either. They will get hit. So if you think it's going to be even worse than a severe recession, maybe a really severe recession, you want to be in cash. So to answer your question about how you ought to be positioned, it's really a question of thinking about where you see the economy in the next 6 months or so, how bad you think this recession is. At the best, where we're talking about a mild recession of 2 quarters, I think you ought to be taking risk off the table and moving to things like consumer staples and utility stocks. If you think it's going to be worse than that, you should be moving more to cash. And again, when you think that about a recession, remember that at what's priced in, I think, in the index right now is a mild recession and the Fed starting to slow down on its rate increases and actually start to maybe cut rate increases. That's what's priced in. So those are your scenarios. Try to figure out what you want to own now. If you like this video, please give us a thumbs up. Subscribe to my YouTube channel. If you want to see more stuff, including the portfolios, 3 portfolios, you can go to my free site. That's jubakpicks.com. If you want 6 portfolios and some options and ETFs and some riskier plays, some volatility plays, you can go to my paid site. That's jubakam.com. Thanks very much for watching.